And you're a little dark there, Matt, so you might want to point towards the window there on your left. Yeah, that's better. Thank you. So this is AEF's funding series and expertise in money management. And so it's fun to have Matt Silkey with us from PMA Associates, is it called? Is Prudent Man Associates, is that right?
No, we just go by the acronym PMA, but yeah, that was the original acronym. Very good.
Yeah, which has a kind of an interesting sort of history to it, but we'll save that for another day. I'm excited to have the opportunity to learn more about cash flow management from you, Matt. And I know that as a superintendent, I had the pleasure of working with you and your team to invest both proceeds from our referendum, as well as ongoing cash flow opportunities that we had with you. I've set it up so that you can share the slides yourself if that works for you. And I will just fade into the background here. Certainly allow anybody to jump in, unmute, ask questions as we go along. And I saw the slides look like they're going to be really helpful, Matt. So let me know if you need anything.
Yeah, I have share my screen. Oh, says host sharing is disabled.
Oh, sorry. There we go.
That's okay.
Boy, Mr. High Tech here today. I'm just not doing very well.
I'm going to, let's see here. Let's see, that'll be that one. Okay, good. So you should be able to see my screen sharing there. How's that?
I'm not seeing it yet, but I have my settings kind of wacky. So let me ask one of the other participants, Paul or Kent, Lindsay, Tim, can you guys see Matt's slides?
No.
Sorry.
You see a picture of you, John.
Okay.
Wait, hold on.
There we go.
Go. All right.
There we go.
Perfect.
Thank you, Matt. Thanks, Paul.
Absolutely. Yeah, so John, thanks for having me on here. Always happy to kind of share the message and the knowledge that we've gained over the last couple years in our experiences working with school districts. Today, like you said, we're going to talk about a little bit of cash flow and investing. I did set up just a quick overview of PMA here, and then we're just going to kind of go through some of the benefits of cash flowing, how you cash flow, and then sort of how to optimize those investments once you go through that process. So PMA has been in the public sector for over 38 years. We are serving 4,000 public entities across 14 states. We've got about 130 employees, most of them actually outside of Wisconsin. Got an outstanding team of 9 individuals here within the state to serve, I believe, 270-ish entities. About 190 of those are school districts of varying sizes. And PMA as a whole, as of 12/30/21, was managing about $29.7 billion in assets under administration. So kind of a cash flow why here. So the cash flow is something that we put together to help districts identify needs and identify opportunities. So these come in many different forms. Obviously, districts have different funding dates. Districts have different liability dates. They have different liability schedules. And they're all, they come in all shapes and sizes. So sort of the cash flow benefits, so things like budgeted surplus and deficits, changes in fund balance, salary, benefits, utilities, other cost increases, things that that are going to be either occurring this year or occurring next year. So increasing and declining enrollment, aids, grants, tax levies, and fund balance transfers. Sort of one of the things that we round out the conversation with is those really one-off transfers and transactions. And you take all that information to plan ahead. So it provides lead time for the district, the accounting office, administration, to sort of make choices, to have lead time to discuss the choices that they would like to make prior to the arrival of the need for those choices. So how we start is by taking budgetary information. So this is strictly funds 10, 27, 50, and 80, broken down by source and object. And we obviously we remove debt service, as you see there. And then we will pull in prior year actuals. So this is ideally 3 years of history. You can do it with less, but sort of to have that average over time is really what we're looking for. And then again, we make adjustments on those monthly basis numbers for one-time transfers. So like the 10 to 27 transfer in January, oftentimes it's the 10 to 30 transfer and what have you. So just kind of taking into consideration all of the different timing that districts have for dollars that come in. Some districts do, they run a number of grants. Other districts don't go out for a large number of grants. Oftentimes there are districts that receive the vast majority of their funding over the course of January and February in the month, and then they have to go basically withstand their cash flow for the period, better half of 10 to 11 months there. And then obviously state aid that rolls in. That calculation is complex, as I'm sure everybody who's viewing this is aware. But these are all considerations that we take into account when we go ahead and build cash flows with people. So customizing them for districts, we will talk with the offices about payroll and AP dates, revenue dates, so if you have a monthly payroll, is it biweekly? Is it just 2 times a month? What is the next payroll date that occurs? Do you have a large payout in January? The biggest problem that we run into sometimes, which is not too difficult to overcome, is just the accrual method of paying out summer payrolls. And we just kind of have to go and apply those figures to the month, because we do use a cash basis assumption for this process. So, and then, these are just some of the outputs here that we get. There's a revenue analysis, there's an expenditure analysis showing the sources and the objects for which you are paying your dollars. Nothing that the districts don't know, but a very consolidated report nonetheless, just to show districts monthly cash flows as they move forward, fund balances at the beginning of the fiscal year, projected fund balances at the end of the fiscal year. And then really what we get out of it is a sort of a daily cash flow. So you've got 3 columns here. You have revenues along the left-hand side. You've got expenditures in the middle. And then what we have the ability to do is actually build in investments. So the column on the right is going to be maturities and investments. And so what we do with those investments then is we bid those out across a vast network of securities dealers and financial institutions for whatever dates that we have them, the outputs, and we'll kind of take a look at those outputs here in just a second. But whatever those are, we take those, we bid them out, and ideally, the markets will return an efficient and competitive rate for the networks that we utilize. So as you build these optimal investment schedules, there are really a couple things to take into consideration. First and foremost is going to be, what is the minimum level of liquidity that the district would like to utilize? And that is going to be essentially the buffer between meeting your liabilities and the maturities that are rolling back into your account as we have built out this investment schedule. And sort of how that looks from a visual standpoint is this. So we have this slide. This is one of the graphical outputs that we get from this cash flow. The bar along the bottom is what you see as that's going to be the minimum level of liquidity that the district has requested. So here it looks to be $10 million. This would obviously be a sample from what would be a larger one that has the short-term cash flow borrow. So those red numbers there are not only going to show that this district's cash flow falls below their minimum level of liquidity, but it also falls below zero, meaning that at some point in the year, this district will have to borrow upwards of $10.7 million to meet those short-term liabilities. So we use this file to build out the investments, and you see that some of these, basically what we get is it looks like a shark tooth or a saw sort of up and down graph there over time. The green is going to be liquid investments. And then what we have the ability to do is build out some mid short-term investments. And you see those in the light blue there, and how that sort of fills your schedule and how that money sort of rolls back in as you need to meet those liabilities over time. And when you build out those investments within the system, it utilizes the funding dates that you have that are predetermined, as well as the liability dates that you know of, meaning mostly payroll and our large AP transfers. And it puts together a daily proposed investment schedule. So you see here along the right-hand side, this district is going to be receiving funds July 15th, 2021. This district, before that date, knows that they can invest $7.6 million for 42 days. They know that they can invest $7.9 million for 56 days. They know that they can invest $7.9 million for 70 days, etc. So what you have is a down to the day count of how many days you can invest your dollars for. And again, what we do is we take each one of these day counts, each one of these dollar figures that correlates to those, and we bid those out across a network of 1,600 financial institutions across the country, as well as 50 securities dealers. So kind of turning the page here, just to kind of talk about the investments themselves, I did prepare a little bit of market data just to kind of provide an update with where things are at. I'm sure, as everybody's well aware, inflation has been soaring over the last couple months. And we're going to touch on that here. But within the state of Wisconsin, you've really got 5 categories of investments that you can invest in. So they all fall under state statute 660603. That is going to be bank deposits, U.S. Treasuries, U.S. government agencies, repo agreements, and commercial paper. Now, we have the ability to bid out commercial paper for people, but over time, we have found that it's a bit riskier than a few of the other investments that you see here. So we don't necessarily provide commercial paper to people on an individual basis anymore, but we do utilize it within some of the money market funds that we manage. And it's really important to remember that money markets are not considered bank deposits. They are considered investments just because of the underlying portfolios that the dollars are swept out into every single night. So that is why with money markets, you do not see the FDIC insurance that you will with a bank deposit. Now, that's not to say we don't have a number of reciprocal relationships with larger and regional banks where we have these bulk deposits that are going to be collateralized for the districts, and that's going to be an option as well. So as we look at the Treasury curve, so this is going to be basically as of the end of February. So very, very, very steep Treasury curve here in the near term. Forward the curve, though, I mean, we're already looking at opportunities around the 90-day or 3-month period. The 1 year, I believe, at the beginning of the year was around 40 basis points. And I believe it kind of topped out over the last couple of weeks around 1.16. So really driving the market right now is U.S. Treasuries. There are a ton of opportunities out there for districts who can't invest for a full year. 3-month, 6-month, 9-month rates are all available. Many of the banking institutions at this point in time are still sort of on the fence about even accepting large deposits. Many of them are still flush with cash from all of the stimulus packages that had come out. And so it can be expensive for them to insure all of the deposits on hand. And so when we do bid out investments, we have found that over the last couple of weeks, treasuries have really been driving the market. So The 1-year forward curve really shows, though, that rates are probably going to be leveling out. This next slide here that I'm going to show you in just a second is an indication of where all of the members of the Federal Open Market Committee essentially believe rates should be as of a specific point in time. And it's one of the tools that we utilize in analyzing many investments with people. So it's one of my favorites actually as well. So this is a dot plot. This is showing where each one of those yellow dots is a vote for a member of the Federal Open Market Committee, and they are set to meet here in about 9 days. So they're going to meet on the 16th. There was a large expectation for them to bump up rates about 50 basis points. Many people think that they're going to trim that back to bumping up the range, I should say, so the federal effective rate range to 25 to 50 basis points. Right now, it still sits at 0 to 25, which is where you see all of those yellow dots at on the left. That's 2021. So sort of the average, I guess, is sitting right around 75 to 80 basis points of where many people on the committee believe rates should be at the end of this year, which means that, you know, we are sort of expecting them based on this here to move on rates a handful of times to reach that 75 to 100 basis point effective rate range. Now, the markets themselves, though, have at least as of a couple of weeks ago, priced in 7 rate movements this year. So rates have come up considerably versus what the Fed might be doing. Now, obviously, it remains to be seen how these expected movements here in March are going to affect inflation. Obviously, there are developing there are developing storylines in Europe right now that are going to be affecting our markets as well. So really interesting to see where we go, but I would absolutely expect them to move at least 25 basis points here in a couple of weeks, which is going to affect the shortest. And I'm going to go back here. That's going to affect is the short-term interest rates on the left-hand side there, where you see, you know, 0 to 30 days. The effective federal funds rate right now is still at an 8. And it really skyrockets up to about 50 basis points as you get to the sort of 6 to 7 to 8 month investments. So those money market rates that we're talking about earlier, those are probably going to be coming up in a couple weeks here, if not shortly thereafter. So, and here are a little bit of the market rates that we've seen over the last, this is as of Friday, I believe. We've got 3 different types of investments there down at the bottom. So CDs, that's going to be your bank product. That's going to be your $250,000 FDIC insured CDs right there. So 180 days, you've got 6 months, 270 is 9 months, and then a year, 18 months, and 2 years. And you can see exactly where those rates are for the different types of investments. Again, you know, treasuries, given the graph up there, like I said, they have been driving the market. So if you have any opportunities whatsoever to invest for 6 to 9 months, just know that the market has changed from what we've known it to be for the last couple of years. And there are definitely opportunities out there for you. I'd be happy to discuss those opportunities with you, whatever they may be. We do a lot of general fund investing. We do a lot of OPEB investing, a lot of Fund 46 investing, and then obviously, you know, we manage a large number of bond proceeds accounts as well. So happy to speak with anybody at any point in time. If you'd like to reach out to me, here's my email address. You can do so, and I'd be happy to talk.
Thank you, Matt. I had a question just going back to something you were talking about earlier, and it was the sort of multi-year analysis of investing and then borrowing, you know, where they were in the red for a few months, and yeah, right there. So in your experience, I guess my question is, in your experience, does it make sense for a district to invest in such a way that there is short-term periods of borrowing? Is that fiscally remunerative, so to speak? Is that something you see working well?
So that's not something that's driven really by us necessarily. We forecast cash flows for districts. So I spoke predominantly today about investing and optimizing those investments through cash flow. We actually operate a short-term borrowing pool as well. I believe last year we had 17 participating districts, and we ended up bringing, I believe, about $97 million to the market to help those districts fill that red area. So short-term borrow, some districts have to do it, some districts do not. But we do utilize these cash flows to sort of predict those numbers and then work with bond counsel to basically make sure that they're within state statute. And so that's what that red represents. When it comes to investing while cash or short-term borrowing, I will note that if you are going to be investing those proceeds in a normal interest rate environment, you typically are going to be required to file arbitrage figures with those, just because, you know, it is oftentimes a tax exempt borrowing. So they just basically, the IRS just needs to make sure that people aren't borrowing money to make money.
Yeah. So I guess I just rewinding, so to speak, it sounds like you help districts from soup to nuts, so to speak. Like, let us help you analyze your cash flow. We do that with 2 years worth of revenue and expense data, and then we can set up a model for you that can maximize your ability to gain investment returns. Is that kind of the summary?
That's exactly right. And it's important to note too that all of these services are provided through WISC, which is the Wisconsin Investment Series Cooperative. That is a intergovernmental agreement that contracts PMA, who I work for, to service their clients. So like I said, I believe there's about 270 participants within WISC. And when you are a participant of WISC, which costs anything, it merely needs a resolution passed at the board level, you are presented with all of these services at no cost. So PMA does make money when we offer the investments that we build out in these cash flows. But for the cash flow services themselves, all you need to do is be a participant of WISC.
Yeah.
And if you're not a participant, how are your fees determined?
So we cannot work with individuals that are not participants of WISC. So in order to begin the process, that would be the first step, is to bring the resolution to the board. Essentially, the resolution just says that you're going to abide by the intergovernmental agreement bylaws. So it's a 3-page document, and I'd be happy to provide it to anybody who has interest.
That'd be appreciated.
Sure.
And that's free to belong to WISC, right?
Correct.
All right, thank you. My question is, to get an analysis like of this, is that what's the timeline, and excuse me, and I assume no costs for WISC members?
Correct. If you're a participant, you can be provided a cash flow analysis at no cost. I will say that it does take a little bit longer to initially build the cash flow, but once you have the file working, it's far easier to update them on an annual basis, because you have many of the numbers already in the system, and the numbers end up averaging themselves out even more so over time, and they really are able to provide you with some accurate figures if managed and used properly. So yeah, updating them, I would probably say, could be done in probably a couple business days. I would probably want to give.
Thank you.
Yeah, absolutely.
Hey, Matt and or John, could you either link to this or send out to us that resolution you talked about for WISC, as well as, you know, some contact information and how we go about looking at doing this? You know, we have a decent fund balance. We've been doing local investments, but I see the opportunities opening up with inflation, where we should be able to start doing some different things again, like we did, well, many years ago. So anything that you can do to help with that be appreciated.
Absolutely. I'll connect up with John after the presentation and make sure that everybody receives not only a copy of the slide deck, but my contact information and a copy of the resolution just for their review.
Thank you.
Yeah.
I'll connect all of you, and I'm the phone caller. If you want to email me or be in touch some other way, you can certainly get in touch directly with Matt. But if you want to be in touch with me, I'm happy to include you on the email.
Excellent.
Any other questions for Matt?
Well, if
That was
John, I just sorry, I just wanted to say thanks again for having me on, and I look forward to talking to some of you guys a little bit more later on.
Yeah, thank you, Matt. It's always interesting to hear about this stuff, and I appreciate the work that you do. And it's like so complicated after you get past the early level. Like, what are the people on the Federal Reserve going to be suggesting in terms of what comes next, and all the stuff that you predict and project and do so well at. I appreciate it. Thank you for your time. I'll look forward to that board resolution, and I'll get everybody an email out here as soon as possible. And any questions can come to me or to Matt. And thanks again, Matt.
Thank you.
All right.
Thank you, guys.
All right. Take care, everybody. Watch for the video to be posted also on the AEF YouTube channel. And that notification will be coming out very soon as well. Thanks again, everybody. Take care, Matt.
You too.
Bye.